When an economy is firing on all cylinders, the physical momentum is overwhelming. Supply chains accelerate, labor forces max out, and production reaches maximum capacity. Then, without warning, that momentum evaporates. Inventories pile up in warehouses, capital freezes, and production lines grind to a chaotic halt. Over a long enough timeline, macroeconomic growth trends upward. Living standards rise and total output increases. But the day-to-day reality of a free market is defined by these violent, unpredictable short-term fluctuations. We can map this behavior mathematically. On this chart, the x-axis tracks time and the y-axis tracks real GDP. If an economy grew smoothly, it would follow this perfectly straight, upward-sloping trend line. But the market actually moves in a volatile wave that strikes rapidly above and below that baseline. Economists call this rhythmic fluctuation the business cycle. We track the position of this wave by measuring aggregate economic activity, specifically gross domestic product, national employment rates, and total income. To survive in a free enterprise economy, we must map the exact phases of this wave, understand the specific variables that force it to rise and fall, and identify the data indicators used to forecast its next turn. Mastering this cycle is the dividing line in strategy. Firms that ignore it fail during contractions. Firms that anticipate it use the volatility to capture market share. This diagram illustrates the standard theoretical model of the business cycle. Here, we can observe how the actual real GDP curve oscillates around the steady growth trend line through 4 specific phases. The first phase is expansion. During this upswing, national output, total employment, and aggregate demand rise simultaneously. It operates as a self-reinforcing loop. High consumer spending drives corporate profits up, which gives businesses the confidence and capital to increase their investments and hire more workers, who in turn spend more money. As production maximizes the available productive resources, involuntary unemployment drops to near zero. Eventually, the expansion hits the peak. The economy hits a hard resource ceiling. Inputs like raw materials and skilled labor become scarce relative to demand. Input prices spike, pushing output prices up rapidly. The cost of living strains fixed income earners. Consumers begin to review their spending on durable goods and housing, causing actual demand to stagnate. Economic growth stabilizes, preparing to reverse direction. This triggers the contraction, or recession phase. The primary mechanic here is a mismatch between supply and demand. Producers rarely recognize the exact moment demand stagnates, so they maintain their high levels of investment and output. Supply rapidly outpaces demand. Warehouses fill with unsold inventory. Producers react by slashing future investment plans, canceling equipment orders, and laying off workers. Stock prices fall, and bank credit shrinks as profit expectations collapse. The contraction finally bottoms out at the trough. If severe, this becomes a depression. Growth rates turn negative. Industries suffer from massive excess capacity, bankruptcies multiply, and investor confidence is entirely destroyed. The global GDP dropped 15% between 1929 and 1932 during the Great Depression, leaving consumers with virtually no disposable income and halting global trade. But the cycle eventually pivots. Pervasive unemployment forces wages down, and input prices drop to levels that finally allow for profitable reinvestment. These lower costs present an opportunity for forward-looking producers to invest again, sparking a recovery that pushes the economy back into expansion. While market dynamics tend to follow this 4-phase sequence, the timing is rarely consistent. The duration and intensity of a boom or a depression remain irregular. Because business cycles lack a uniform schedule, predicting the exact turning point of an expansion or contraction is the central problem for corporate planners. To solve this, economists monitor 3 temporal variables, or indicators, to track where the economy is headed. Leading indicators are measurable economic factors that shift before aggregate real output changes. We look at variables that react to future expectations, like early changes in stock prices, shrinking profit margins, or a drop in new orders for capital equipment. But they are not perfectly accurate. Leading indicators can signal a crash that never actually materializes, resulting in false alarms. Coincident indicators describe the real-time state of the market. They move simultaneously with the business cycle. If you want to confirm a shift is actively happening, you check current industrial production rates, retail sales volume, and inflation. Finally, lagging indicators are variables that shift after the real output changes. These serve as historical confirmation that a pattern has occurred. Unemployment rates and corporate profits often fall into this category, reflecting the damage or growth of a cycle phase that has already passed. Proper forecasting requires synthesizing all three data streams. Leading indicators warn of an upcoming shift. Coincident indicators confirm the shift is actively happening, and lagging indicators prove the cycle has permanently turned. The indicators tell us when the cycle shifts, but we still have to understand why. The root causes fall into two categories: internal, endogenous drivers within the market itself, and external, exogenous shocks. British economist John Maynard Keynes argued that internal fluctuations are driven primarily by swings in aggregate effective demand, the willingness of consumers to purchase goods. Monetarists like Ralph Hawtrey argued the cycle is a purely monetary phenomenon, triggered by changes in the money supply and the availability of credit. The 2008 global economic crisis clearly demonstrates this monetary trigger in action. Following a prior recession, the U.S. Federal Reserve aggressively reduced interest rates. This flooded banks with excess liquidity, creating artificially cheap credit. Banks lent recklessly to subprime borrowers, inflating a massive housing bubble that eventually collapsed under its own debt. Other economists, like Joseph Schumpeter, pointed to different internal forces, arguing that trade cycles occur due to sudden bursts of technological innovation and waves of psychological optimism or pessimism among investors. But the market is also battered by external drivers. These are uncontrollable events outside the economic system, ranging from wars that divert resources, to weather cycles that destroy agricultural yields, to massive technology shocks. The information technology, or dot-com bubble of 2000, was a textbook external technology shock. The rapid advent of the internet triggered extreme investor optimism. Venture capital flooded into internet startups with no revenue models, creating a localized, unsustainable boom. When the capital dried up, the bubble burst, liquidating half the sector and dragging the broader economy into a downturn. Real-world business cycles are rarely triggered by a single variable in isolation. They are complex collisions where an external shock, like a new technology, is amplified by internal psychological optimism and fueled by monetary policy. Every managerial decision happens within the specific context of the current business cycle phase. Economy-wide trends do not dictate the same fate for every sector. Here is our baseline GDP wave. Some businesses are highly cyclical. Firms in fashion retail and heavy construction have revenue models tightly linked to the overall GDP rate. These businesses face catastrophic drops in demand during a contraction, but reap massive gains during an expansion. Surviving this requires highly precise strategic timing. Expanding production capabilities during a late-stage contraction positions a firm to capture the upswing. Conversely, taking on heavy debt at the peak guarantees insolvency during the crash. Meanwhile, non-cyclical or value businesses operate differently. Discount retailers or providers of basic necessities can actually see demand rise during an economic downturn, as consumers abandon premium products for cheaper alternatives. The free market engine breathes in cycles of boom and bust. Anticipating indicators and aligning production with these shifts is essential for long-term corporate resilience.